Holy flippity flip flop flap and smokes, everyone. The Federal Reserve and the banks are in full panic mode right now, as over $500 billion in deposits has been withdrawn from the banks. They'd like to tell you, don't worry, the banking crisis is solved. It's all over. There's nothing to worry about. But that couldn't be further from the truth. We've also got some Federal Reserve minutes that has been released, and the Federal Reserve is admitting now that we're likely going to be entering into a recession very, very soon. Now, what you have to know about with these central banks is they'll never tell you like it is. So when they tell you the economy is great, you'll know, well, we probably have a bit of a weak economy. When they tell you the economy is weak, you know we're probably in a recession. When they admit we're going to be facing a recession, you better believe we're probably going to be facing a depression. So everyone, what is the Fed so worried about? What is really happening with the banks? Well, let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, everyone, look at this. Fed expects banking crisis to cause a recession this year, minutes show. Well, I think this is very obvious, everyone. And what this is going to lead to, for those that don't understand, this is going to lead to a credit crunch. This is going to lead to the banks to be very, very careful who they lend their money to, because their deposits are fleeing and they don't want to have more bad loans on their books when we're about to get their earnings reports to see how bad their books really are. And I think we may have only just seen the tip of the iceberg. Listen to this. The Federal Reserve staff gave FOMC members a presentation about potential repercussions from the failure of Silicon Valley Bank and other turmoil in other financial sector that began in early March. But they said, don't worry. The banking sector is sound and resilient. While the 3 banks collapsed within a week, and the only reasons why more banks didn't collapse because you gave them unlimited amounts of bailouts, no, I don't think the banking system is sound or resilient, and I also don't think it's sound or resilient if they don't have to have any reserves whatsoever. But staff economists said the economy will take a hit. Yes, it will, everybody, a very big one. Given the assessment of the potential economic effects of the recent banking sector developments, the staff's projections at the time of March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years, the meeting said. Well, what this means is, everyone, we are most likely in a recession right now, but they won't actually declare it until 6 to 9 months later. And they're saying this is going to be a slow recovery. The economy may not fully recover for another 2 years. The crisis has caused some speculation that the Fed might hold the line rates, but officials stress that more is needed to be done to tame inflation. And we did just get the latest inflation report yesterday, everyone, and US core inflation slows only a bit, keeping the Fed on track to hike rates. So excluding food and energy, consumer prices rose 0.4% in March. So that means if you annualize that, inflation is still going at nearly 2.5 times the Federal Reserve mandate of 2%, sorry. And we all know real inflation is actually double the official figure. So it's more like we got 8 to 9% inflation right now. So the Federal Reserve is very, very worried. But do we have some new news, some new data to tell us that yes, there is reason for concern? Well, people, yes, we do. First things first, Bank of America clients withdraw $2.3 billion from US stocks of all sizes. So real estate shares saw the largest outflow since July 2021, and communication staples were only 2 areas seeing inflows. So this is the second consecutive week of outflows, Bank of America strategists led by Jill Carney-Hall wrote in a note. The analyst didn't specify the reasons for withdrawals, which was evident across all client groups, and selling was pronounced among institutional, retail, and hedge fund clients. So everybody is getting out of Bank of America, everyone. But it's not just Bank of America, everyone. And again, that is just the tip of the iceberg. Look what's going to be announced when all the big banks release their latest earnings reports and we get to see their balance sheets. Look at how much money has been withdrawn from the banks since the banking crisis. Now, you may want to sit down because you may fall over after this. Look at this. Top US banks to reveal $521 billion deposit drop, most in a decade. So that's right, everybody. This is the biggest withdrawals we've seen since 2008. So on one hand, they're telling you the banking sector is sound, it's resilient, it's fine, nothing to worry about. Well, we all know they have to say that, everybody, because they will say up until the day that, the big 4 banks collapse, they'll tell you right up to the minute before they collapse, don't worry, everything's fine. So JP Morgan, Citi, Wells Fargo kick off industry reports Friday, and failing to address deposit levels is a failing grade. Now, look at this, everyone. This is absolutely crazy. By far the biggest issue for the banks is around deposits. both for the quarter and for March. Wells Fargo & Co. analyst said in an interview, non-answers are a failing grade for this take-home exam. So we can see these charts here, everyone. We can see here Bank of America has seen massive drops from 2.07 trillion all the way to 1.88 trillion. Same, we've seen JP Morgan. They've had an even bigger drop from around 2.5 trillion to 2.3 trillion. And we've seen Wells Fargo had big withdrawals as well from around 1.48 trillion to 1.38 trillion. But that's just the big banks. What we're seeing right now, it's even worse for the small regional banks. So Western Alliance Bancorp learned the lesson the hard way last week when it released updated financial information that left out data on deposit levels. So this is very, very worrying, everyone. They released their report, but they didn't include their deposits. Shareholders sent the Phoenix-based firm stock tumbling until it released deposit data later in the day that was better than some analysts had feared. Yeah, maybe they went and got themselves a loan from the Fed. For small competitors like Western Alliance, the problem is twofold. Their customers also want more for their money, and the recent collapse of 3 regional lenders have left customers jittery, prompting them to yank their cash and store it in larger banks instead. But that's not all. The turmoil's also weighed on bank stocks. The KBW Bank Index is down 19% this year and lost 25% in March alone. Regional banks were the biggest losers for the period, with First Republic Bank down 89%. It's absolutely crazy, everyone. First Republic down 89%, and they would have collapsed if they weren't bailed out by the other banks. So the coming first quarter disclosure from the big banks could intensify concerns about deposits mix, and should lenders miss expectations, set off more inquiries about the health and future of the industry. So I don't know about you, but I'm very, very excited to see these reports from the banks to see how healthy and how sound and resilient the banking sector really is. And so where is everyone putting their money? Well, they're flocking to money market funds. So consumers and companies have flocked to money market funds, sending the total amount in these funds to a record 5.2 trillion from 4.59 trillion a year ago. While raising rates could force banks to cough up a few more basis points to savers, they're also handing them record amounts of net interest income for the biggest banks. That's boosting net interest margins, a key gauge of profitability that measures the difference between what a bank pays depositors and what it collects on loans. So that's right, interest rates are soaring, mortgages are getting more expensive, credit card interest rates are going up, the banks are making big money from these loans, but they don't want to give you anything on your savings whatsoever. So people are taking their money, they're voting with their money, and they're putting in a money market fund. So the reason I'm making this video, everyone, and why this is so important, and what you have to understand is everyone's getting very, very bullish. And it's quite crazy the reason they're getting bullish. They're like, well, the banks are getting bailed out. They're printing free money because the banking systems have failed. How bullish is that? Well, I don't know about you, but banks failing, I don't think it's quite bullish. And now the Federal Reserve is saying there's going to be a recession. Some people may say this is great because then they're going to cut interest rate. Well, again, they're cutting interest rates because we're going to be facing some huge economic concerns coming ahead. And like the chart I've shown you, be careful what you wish for, because even if the Federal Reserve does pivot, that does not mean the markets are bottomed. Many times the Federal Reserve has pivoted only for the market to crash another 20 to 30%. So everyone, this could just be the calm before the storm. We're seeing this situation, what's happening with China, Brazil, what's happening with the BRICS nations, with them trying to create their own currency, with the dollar losing value. There still is so much other things happening geopolitically that could mean huge headwinds for the markets. And again, while they're telling us that banks are sound and resilient, well, we're going to have to wait till we get the data and see in black and white how strong they really are. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. It's good to be back making content again in the office. So thanks for watching. I'll see you all in the next video.